Hi, my name is Aditya Patnaik, and I'm an investment advisor at Sprott Global. The following is a recording of a Q&A I conducted with Rick on 20th of July 2020. The conditions that have set up a secular bull market in precious metals and in mining equities are also conditions that will likely create continued volatility over the medium term. I hope you enjoy the selected excerpts from our discussion.
Rick, the topic of the discussion today is dealing with volatility and the risk in the markets. I'd like to begin this discussion with your view on the consequences of credit expansion. We've been talking about the unsustainability of using credit expansion as a tool for propping up asset valuations and essentially the stock market for several years now. With interest rates near zero, this is now the primary tool that is being used by the Fed to address economic concerns in the market today. In a very simple sense, there are two ways in terms of how this may end. On the one hand, there's hyperinflation, and on the other hand, the stimulus goes away and we see serious deflation. How do you see these conditions playing out over the medium term in terms of the value of money?
I would add one more potential in the intermediate, which is to say 3 to 5 year time frame, and that is that we continue to muddle through, which is to say neither spectacular inflation as a consequence of the fact that the devaluation of money is inflationary, but the broader economic circumstance is deflationary. My expected outcome in the 3 to 5 year time frame, which is the time frame that we have to consider in terms of making investments and speculations, is that in fact we muddle through with lots of volatility. I am personally not expecting in the next 3 to 5 year time frame, at least in terms of U.S. dollar denominated assets, the type of inflation that we experienced in the 70s. Nor am I expecting in the 3 to 5 year time frame a major deflationary depression. There is too much liquidity in the system, even private, non-counterfeited liquidity, and there is still too much confidence in the system, I think, to generate a major recessionary depression. So my suspicion is that the easiest thing to look for is volatility in a circumstance where the gains that we have seen in major market equity prices moderate, where the conditions that we see on Main Street, that is to say in the real non-market economy, are very tepid, to say the least, and where there is continued effort by the government to stimulate liquidity, which devalues the currency. I wouldn't be surprised to see the type of circumstance that those of you who were around in the 70s remember, which is to say stagflation, where the basket of goods and services that you purchase increase by 4, 5, or 6% a year compounded. You would experience larger increases in price were the economy stronger, but the economy, I don't think, will be stronger. At the same time that the yields that you get on savings products, which is to say certificates of deposit, bonds, and things like that, stays very low. The stagflation is a very, very bad circumstance for the broad economy and a very bad circumstance for the living standards of Americans. It is probably, unfortunately, a very good circumstance for the gold price, and as a consequence of that, a good circumstance ultimately for the market capitalizations of the better gold companies. I qualify that response because I think that we're going to see really, really, really incredible volatility. The speculators, of course, prefer upside volatility to downside volatility, but I think you're going to see lots. I think you're going to see volatility because we have both inflationary elements and deflationary elements in society, because the broad economy is weak, but the financial markets are accommodative. And we're also going to see volatility simply because we're going to have peaks in value in investor confidence in all asset classes. And finally, Aditya, I apologize for the long-winded nature of the response, but volatility is a hallmark of precious metals recoveries. If you look on the chart that we so frequently refer to, which is the Barron's Gold Mining Index chart, what you will see in these wonderful recoveries from oversold bottoms, if you look closely at those recoveries, is the appearance of many cyclical declines in secular bull markets. And these cyclical declines are not minor. 10%, 15%, 20%, 25%, going all the way back to 1975, a 50% cyclical decline in the secular bull market. And while that will make you all uncomfortable, you all need to count on it.
Now, the liquidity is, of course, predicated on the fact that the stimulus continues.
I don't see any circumstance where the stimulus doesn't continue. It has major bipartisan support and major voter support. The truth is that while the stimulus is really counterfeiting, and frankly, if you and I did it, we'd go to jail. But when the political class does it, it's called policy, and it gets them votes. So I don't see any possibility that quantitative easing, the manipulation of interest rates, I don't see any circumstance where those two things wouldn't occur. I could see a circumstance perhaps where the direct Fed buying of asset classes, which is to say the Federal Reserve Bank buying equity indexes and buying junk bonds, buying municipal bonds, I could see that be pulled back. I'm not saying it will. I could see that pulled back, and I certainly hope it will be, but I suspect that the impact of that on capital markets would be ugly.
A question I often get from my clients is about holding mining equities in a fiat currency that is being devalued. The capital gains are effectively being negated by holding the equity that is in a currency that is losing its purchasing power. What are your thoughts on this?
Ironically, that turns out to be untrue. As an example, if one of the things that's happening in the gold mining industry right now is that many currencies are devaluing relative to both gold and the U.S. dollar and devaluing faster. In those circumstances, because the product that they sell, which is to say gold, is denominated in U.S. dollars, which is relatively strong, while their input costs are denominated in currencies like the Australian dollar, the Canadian dollar, the Mexican peso, the South African rand, their costs are going down at the same time that their revenues are going up, which is a wonderful, wonderful thing. What you say in a different context with regards to U.S. producers simply means that the purchasing power associated with what you would likely receive when you sold your equity investment goes down. That's something that you need to consider. What we've learned in prior gold stock bull markets is that in those circumstances, the escalation of value in equity prices tends to greatly outpace the depreciation in the purchasing power of the fiat currency that the valuation of the equity is denominated in.
The topic of the discussion today is volatility. You've often talked about the importance of time in investing and being able to hold one's investments over a long duration in order to generate real wealth. How would you recommend investors prepare for and invest through this volatility?
I think the way that you prepare yourself for volatility is precisely that you attend discussions like the discussion that we're having right now, and you educate yourself. If you are educated and prepared for volatility, and also if you have done enough work that you are grounded in the reasons for a secular bull market, then volatility becomes a tool, and bear markets become a tool. What the truth is, what downside volatility is a series of sales. And if you're looking to increase your exposure to an asset class, sales are good. The difficulty with regards to that is that most people don't have enough faith in their portfolio and the companies in the portfolio, often, Aditya, for very good reason, that they don't have the faith to either hold through a decline or buy through a decline. Warren Buffett, who I love to quote for many reasons, discusses this phenomenon well, and I'll sum up his viewpoints in two quotes that come from him. The first is, don't buy a share in a company where you would not, were you financially able to, buy every share in the company and take it private and live through the next 5 years of economic circumstance without recourse to a market to sell it into, which is a different way of saying understand the value of the company well enough that the share price, the share quote, is irrelevant to you. The second one is probably much more appropriate to investors, which is to say, don't buy a share in a company where you wouldn't be delighted to see that share price fall 30% or more in a month. So you could employ the same intellectual capital to acquire more of the company at a greater discount than what it seems to be worth to you. I think if you right size your investments, which is to say that your portfolio allocation to speculation, your portfolio allocation to investments, and your portfolio allocation to liquidity both in the form of bullion and also cash, is appropriate to your circumstance. And also, if you have taken the time, either directly or in conjunction with your advisors, of understanding how each position in your portfolio fits into your personal portfolio, into your own reward expectations, time expectations, and risk expectations, you will be much better equipped to take advantage of volatility and much less likely to be taken advantage of by volatility.
I recall a discussion we had last week where you used the term stock pickers market to describe the market that we are headed into. I think it would be useful to revisit that point in this discussion.
Bull markets morph, and there might be 10 or 12 themes in a bull market. And the flow of funds moves from theme to theme within a bull market. And each theme becomes relatively overvalued and relatively undervalued. And in each theme, there might be 3 or 4 stocks that are best emblematic of that theme. It is important that rather than attempting to form a portfolio out of, I don't know, the 1,000 or 2,000 companies that pretend to be mining companies that are publicly listed, that investors pay attention to those portfolio themes that are going to lead, rather than the ones that are leading now, and to pay attention to the best names in those sub-themes. Wayne Gretzky famously said that he succeeded as a hockey player not because he was the biggest or the fastest or the strongest or the most coordinated, but rather because he attempted to skate to where the puck was going to go rather than to where the puck was. Stock picking is all about, first of all, understanding what companies fulfill your own needs with your own portfolios best, having some sense of the sectors and subsectors in the market that are overpriced and underpriced, and some sense of where market leadership is going to go, that is to say, sector analysis. And then under that, understanding the companies that offer up the best risk-reward parameters in terms of the sector analysis that you've done. An example would be right now, the generalist money has come into the best of the best, the biggest and the best companies in the sector. And the consequence of that is that their market capitalizations and their trading liquidity is high. The second-tier companies and the single asset producers have lagged the big companies. This is setting up a perfect circumstance for a mergers and acquisition market. And in fact, the merger and acquisition theme has served the Sprott portfolio managers extremely well. As leadership comes into the companies that the market believes will be acquired, likely, I'm not saying likely, but perhaps the undervalued sector relative to that would be companies that had the potential for lateral merger, which is to say mergers that involved companies simply getting bigger, or development stage companies. But within each subcategory in a mining stock bull market, and there may be 10 or 12 of them, there are always 2 or 3 or 4 companies that best exemplify that trend. And so my suggestion is that there are probably, at any point in time, for 95% of the population of speculators and investors in the gold stock market, only 65 or 70 companies that are worth considering out of a much broader universe. That doesn't mean that some of the outliers, that some of the not best companies can't make you an extraordinary amount of money. It's just that the probability associated with selectively picking those and making money on them, which is a fancy way of saying luck, it is unwise to count on luck. It's much wiser to count on fundamental analysis and sector analysis.
What would you tell an investor who has made money on promotion and narrative in terms of having those stocks in their portfolios?
Speculating on narrative and promotion is an art form. And people who are good at understanding the impact of a narrative on a market psychology. I remember the famous newsletter writer and a very close friend of mine, Bob Bishop, who made extraordinary amounts of money himself understanding the promotion as well as he understood the technical acumen of the people involved or the merits of the project. It's a separate art form. My criticism of it, Aditya, is that, as a guy who hasn't turned on a television set for probably 30 years and doesn't know how to dress himself, my ability to understand the impact of a narrative and trade on the impact of a narrative, let's just say that isn't one of my durable competitive advantages. I have actually studied promotional techniques and promotional campaigns for 35 years, and I'm a little bit better at understanding, if you will, the anatomy and the biology of the stock rigs and stock promotion. I'm notoriously bad at understanding the impact of a narrative simply because the copy in the narrative is usually distasteful to me. I once went for fun to a newsletter copywriting class because I was interested in marketing and how they do what they do. And at the beginning of the class, they give you, I think it was 10 investment themes, and they give you the opening paragraph of copy, 3 different copy approaches to dealing with that narrative. And you were supposed to pick out the best performing, the middle performing, and the worst performing copy associated with selling the narrative. And the course leader, this will make some of you laugh, I guess, was Porter Stansbury. And he told me that I had the lowest aptitude for commercial copywriting of any person who had ever taken the course. What that means is that I'm normally a pretty good investor in terms of fundamentals and value analysis, and a pretty good investor in terms of income statement and balance sheet analysis, and a very good investor in terms of understanding the appropriateness of the personnel's resume to the task at hand. But I'm horrible at trading narrative. So while I think that is a very, very valid speculative technique, I'm less able to help people with it than other people. What I can do is I can look at the now 12,000 portfolios that have been submitted to us for rankings, and I can find promotional groups that have very, very big market share and mind share. In other words, what I can do is identify certain groups of people. Keith Neumeyer is an example, or Amir Adnani, who has spent a lot of money in financial public relations and built very, very large speculative cults around them. I'm not criticizing this. I'm just saying that it is a different discipline than the ones that we're used to. And my own expertise in the discipline comes not so much from understanding the narrative itself as understanding the construction of the promotional technology and simply the preparation that various groups have done over the last 10 years or 12 years to condition shareholder constituencies to buy their stocks as a consequence of the narrative that they've been able to sell.
I'd like to end this discussion on a topic that is also on the minds of many contrarian investors today, other commodities that are currently out of favor like copper. What are your thoughts on Dr. Copper?
Mixed detail. I love the copper business because traditionally, in cycle and out of cycle, copper mines have been extremely profitable. And over the last 40 years, the management teams involved in copper have been generally more rational than the management teams involved in gold. So I love the copper mining business. And large copper mines in the hands of good miners make lots and lots and lots of money. That's the good news. The bad news is that copper is economically sensitive. And my own personal prejudice, with the caveat that I'm not an economist, is that even prior to COVID, we had gone through 10 years of an economic recovery, and that economic recovery was itself partially based on false premises, which is to say artificially low interest rates. In my experience, a 10-year-old economic recovery is long of tooth and is due for some sense of unwinding or reset. That is to say that we were due a recession. The big thinkers, the powers that be, didn't want a recession, and as a consequence, they kept trying to keep that expansion alive through credit expansion and liquidity. But eventually, markets are bigger than governments. The catalyst was, of course, COVID-19, which generated an economic slowdown of its own volition. The upshot of this rather windy answer that I'm giving you is that my suspicion is that as a consequence both of the ongoing COVID requirements, the aftershock of the COVID shock, and the unwinding of a 10-year-long economic expansion, that on a global basis, the economy is weaker in the next 2 or 3 or 4 years than it has been in prior years. And the consequence of that is that demand for finished manufactured products, which require copper, will be less robust than we had anticipated. So although the copper price is less than the incentive price needed for new mine construction, in other words, despite the fact that we're going to go into a production deficit in copper, my nervousness is that the copper market remains muted for 2 to 3 years. I'm not saying it's going to occur, but I think it's more likely than not. If you're going to be in the copper space, I think you want to be in the very, very high-quality names that can sort of weather the last man standing contest. Or if you're going to be in speculative names, that you be in speculative names around mining groups that have access to reasonably low-cost capital, which is to say people like Friedland or people like Lundin.